Hey guys, so you're pitching a VC and they ask you, what are your valuation expectations? Let's find out the answer now.
Ask Alex. Ask Alex. Because you don't know what you don't know. And if you don't know, now you know.
Yeah.
So what do they mean? This is a very similar question to the previous one. What are your deal expectations? But it's focused directly on your valuation. Are you expecting a crazy premium valuation, or are you going to be in line with the market? Fundamentally, investors are wondering if your valuation is way out from what they can afford or not. If you're talking to a seed stage investor and you're asking for 20 million pre, it's quite likely that they're not going to be able to afford to get to their target ownership percentage in your company. And so just throwing in $1 million just may not be worth the effort. And at which point it's easier just to end the conversation now and save everyone a bunch of time. Like, especially at the earlier stages, $1 million difference in your valuation can really make a big difference to their exit value. You may just think, what's the difference between 2 or 3 or 4, but actually it can really make a big impact assuming that you work out. So now determining your valuation is difficult because there is no right answer. You have to be both realistic on the upside without scaring investors off, but on the other hand, you do not want to undervalue a company, leaving money on the table, as well as the VC thinking something's wrong. I've written a blog here on how to approach the question of what is your startup valuation, by the way, when you're asked more directly, which you're free to read, and I'll leave that in the show notes below so you have a little link to kind of check out that blog. So the best way to handle this question, like the others, is to do all you can to have several VCs interested in you. They know there is demand in the market, then the investors are the ones who are going to be the price takers. You can afford to be a little bit arrogant in responding to this question if you know you have a lot of options, but on the other hand, if you don't have a lot of options, you need to be quite careful. Generally, always just be a good guy. Don't be arrogant. No one likes that. Now, typically, you just want to say that you have reasonable expectations and the market, i.e. the investors, are going to set where that is. So what do you need to say? Well, here's an example. Look, this is not a private equity deal. You can't do a DCF on a startup, right? All you can do is compare traction with the other companies having raised in the market to understand, where the market rate is, and pricing happens from investors and the offers that they make. So who we raise from matters to us. So we would prefer to have the right investor rather than a slightly better valuation. Of course, look, it'd be lovely to have both, but we think our valuation will be in line with other deals that have been done in the previous 2 months, and I'm sure you know what they are. So there you go, guys. That's a quick answer to that question. I hope it was really valuable to you. If you want to learn more, head over to alexanderjarvis.com. I've got a load of free content and lots of great tools for you to check out. See you.